Did you know that 90% of traders lose 90% of their money within their first 90 days? It's a harsh reality, but if you're a retail investor, the odds are stacked against you. Most people approach trading the wrong way, and it's costing them everything. Successful trading isn't about chasing quick wins or following the hype. It's about getting the correct education from the right people who have a proven track record. In this video, I'm going to break down the 5 biggest reasons why most traders fail, and more importantly, show you how to avoid these pitfalls so you can start making smarter decisions and actually grow your wealth in the market. The first, and probably the biggest mistake new traders make, is relying on bad information. We live in a world of clickbait headlines where everyone and their grandmother has a hot stock tip that's guaranteed to make you rich. The truth is, most of this information is worthless. It's either outdated, biased, or just plain wrong. If someone actually had a foolproof system for making money in the market, why would they be giving it away for free? They wouldn't. Instead of falling for these get-rich-quick schemes, focus on getting your information from reliable sources. Look for experienced traders with a proven track record. Don't just follow the hype. Do your own research, develop your own strategy, and invest in your financial education. It's the best investment you can make. And let's talk about leverage, baby. Sounds exciting, right? It's like the nitrous boost in a street race. It can amplify your gains, but it can also send you crashing and burning in an instant. Brokers love to dangle leverage in front of you, promising you'll make a killing with just a small amount of capital. 100 times leverage. Turn $100 into 10,000. It sounds too good to be true, right? Well, that's because it is. Leverage is not your friend. It's a loan, plain and simple. And like any loan, it comes with interest and the very real risk of blowing up your account. You're basically borrowing money to trade, and if the trade goes against you, you're on the hook for those losses, plus interest. Leverage can be a powerful tool when used correctly. But for most traders, especially beginners, it's a recipe for disaster. My advice, stay away from leverage and get educated. Focus on building a solid foundation of knowledge and experience before you even think about amplifying your risk. Chapter 3, Protect Your Downside, the Art of Risk Management. Most retail traders are so focused on picking the right stock, they completely forget about the flip side. What if they're wrong? You will be wrong a lot. The market is unpredictable, and even the best traders in the world get it wrong. The difference is they know how to manage their risk so that when they're wrong, it doesn't wipe them out completely. How do you manage risk? It's all about setting stop-loss orders, diversifying your portfolio, and never ever risking more than you can afford to lose. A stop-loss order is like an insurance policy for your trades. It automatically sells your position if the price drops to a certain level, limiting your potential losses. Diversification is another key element of risk management. Don't put all your eggs in one basket. Spread your investments across different asset classes, industries, and geographical regions. In trading, it's not about hitting home runs every time. It's about protecting your downside, managing your risk, and staying in the game for the long haul. Remember, 90% of retail traders lose 90% of their money in 90 days. Chapter 4, Building a Solid Foundation. The top-down approach. Most beginners approach the market like they're picking numbers out of a hat. They hear a hot stock tip, chase the latest meme stock, or just throw darts at a board and hope for the best. If you want to succeed in the market, you need a solid strategy, and it all starts with a top-down approach. Start by understanding the bigger picture, the overall market sentiment, the economic outlook, and the major trends driving the market. Once you have a good grasp of the macro environment, you can start narrowing down your focus to specific sectors and industries that are poised for growth. Only then should you start looking at individual stocks. Look for companies with strong fundamentals, solid earnings growth, and a competitive advantage in their industry. Develop a solid trading strategy based on sound analysis and a top-down approach. Trust me, your portfolio will thank you for it. Chapter 5. The ugly truth about your broker. Let's talk about something nobody really wants to admit, something your broker doesn't want you to know. They profit from your losses. Brokers make money from commissions, spreads, and interest on margin accounts. The more you trade, the more money they make. Most retail traders lose money, a lot of money. So in a way, the broker is incentivized for you to keep trading, even if it means losing your shirt. They're not necessarily rooting against you, but their business model thrives on your activity, not necessarily your success. Choose your broker wisely. Look for one with a strong track record, low fees, and a commitment to investor education. Be mindful of your trading activity. Don't overtrade just to generate commissions for your broker. Focus on quality over quantity. Understand the incentives at play and don't be afraid to ask your broker tough questions. Remember, it's your money, your future, and your responsibility to protect it. Ultras start winning in the market. So there you have it. The 5 biggest reasons why most traders fail and, more importantly, how to avoid them. Trading isn't a get-rich-quick scheme. It takes time, effort, and a willingness to learn from your mistakes. If you found this helpful, hit that like button and subscribe to IBF and share this video with anyone you know who's struggling in the markets. Let's break the cycle and start winning together. See you in the next video.